Right. Well, welcome to the next International Macro History online seminar series. We're excited to have a really useful and provocative paper from David Chambers and Elroy Dimson, both from the business school, Judge Business School at Cambridge University, on long-run asset returns. So I think, David, you're presenting?
Yes, Catherine, thanks. It says I can't share my screen at the moment.
Okay. While we're
Oh, here we go. There we go. Right.
Okay. So the same rules of engagement apply. So any questions that you have for the speakers that occur to you while they're speaking that you'd like answered at the end, please put them in the Q&A. If you have something particularly for clarification that's very urgent, please note it with hashtag clarification, and I'll make a decision whether to interrupt the speaker. And just to be clear, only I'm able to interrupt the speaker for clarification. Okay, and on that basis, David, if you're ready to go.
Yes, thank you very much, Catherine, and thank you very much for having us, giving us the opportunity to present this paper. If I'm a little less fluent than usual, that's not because I don't know anything about the paper, but this is Elroy's slide deck, and so there may be one or two slides that are peculiar to what he was going to talk about. But this is a piece of research which is a survey paper, and so there is no original researcher stuff as such. It is co-authored together with Elroy and Antti Ilmanen of AQR and a PhD student, Paul Rintamäki, who is on the job market this year. And the intention of the paper is to survey the now considerable literature that has been done on the subject of asset class returns over the long run. And the asset classes that we're looking at, in addition to traditional assets such as stocks, bonds and bills, are also real estate, so direct real estate as opposed to REITs, and commodities. And we're primarily looking at what the long run performance looks like. So wherever possible, we're trying to look at the total returns to each of these assets. Given the space limitations that we have with this paper, we don't say an awful lot about risk. And so we're primarily looking at either arithmetic means or geometric means in terms of long run performance. There may be some of you out there that we have not cited in the paper, and I apologize, or we apologize for that in advance. If you think that we should be citing you after I've spoken, after you've looked at the paper, then please do let us know. Okay, so the primary topics I'm going to be talking about here are financial market data that span largely the 20th century, but also go back into the 19th century. Much of what we know in terms of the 20th century, as I'll show you in a second, has documented just how exceptional returns have been in the United States. And that is one of several good reasons why you would want to go back, reach further back into the past to look for more data. I'm talking to a lot of you out there who will appreciate some of these issues, but we're engaged in financial archaeology, where the further we go back in trying to document long-run performance. So we talk quite a bit in the paper about issues that relate to data collection and how we should go about designing indices and computing returns. Once we've done all that, the paper does focus on 5 big questions that we think are particularly important So I'll talk about those and then I'll conclude. So, well, let's start and say something about equities. This is a very famous chart by now that comes from equally famous book by Jeremy Siegel, which is called Stocks for the Long Run. We're showing here now, it's now in its 6th edition. But Jeremy went back to compute stocks, bonds, and bill returns going back to the beginning of the 19th century. And on the basis of that, which showed that stocks generated an annualized return of 6.9% versus very healthily in excess of bonds at 3.6% and bills of 2.5% over those 220 odd years. And on the basis of that, he's been a very strong proponent of investing in stocks if you're a long run investor. One of the questions we address in the paper is just how strong is that evidence? When you look at the 20th century and even on into the 21st century, so what we have here are annualized real returns on total returns on equities in US dollars for the 1900 to 99, then the first 2 decades of the current century, and then for more recent periods. And in all these periods, both in the long and the short run, the US has outperformed everything else, whether it's the UK, GBR, as it's shown here, global equities, Japan, the world ex the US, or Europe. When we're thinking about the future, rather than just being happy to focus on the US experience, it's very helpful to be able to look at other markets, but also to look at out of sample periods, and in this particular context, to reach back into the 19th century. So this data I'm showing you here all comes from the Dimson, Marsh and Staunton data set. This shows total returns in real returns to equities, bonds and bills. So equities are the blue bar, the dark blue bar are bonds, i.e. government bonds, typically 10-year government bonds, and the lightish bar are treasury bills. And you can see for each market, going from Australia over on the left up to, Austria on the left up to Australia over on the far right. You can see the returns for each market, and you can see that the US ranks second over this period to Australia. If we say, well, we want to not just focus on the US experience or the experience of any particular country, but look at global equities as a whole, which is shown as the world here, then you'll see that the total return of global equities over this period was 5% in real terms, which generated an equity risk premium over bonds of 3.3% and an equity risk premium over bills of 4.6%, which looks very good. One question we would like to know is, how representative is this long run period of the longer run past, and what can it help us say about the future? In order to do that, we need to continue to compile historical data sets. There are various issues that need to be addressed. One is that we need to avoid the great temptation just to collect what we call easy data. A very simple example of that is simply to collect data on companies or securities that have survived through to today, and not to take account of any selection bias. We need to think about how we would want to weight the underlying securities in computing an index. Broadly, the two straightforward choices are between equally weighting and capitalization weighting. There's a related choice about how broad a selection of stocks do you want to have, which leads on to the question of how macro consistent is the index that you're looking at compared to the underlying real assets that you're trying to proxy. Fourthly, it's always important to have in the back of our minds how replicable the returns to the historical data sets are. We have how replicable they are by investors. And last, but perhaps most importantly, there's probably quite a number of papers out there that we have not dealt with because they're looking at price-only returns. And we're very focused on looking at total returns, i.e. to include the income component to return, whether it's equities, bonds and bills, or real estate. Okay, so let me give you a very quick example of easy data bias, but a very important one. And this goes back to the estimates that were done originally by Jeremy Siegel for the US stock market. I showed you the chart a couple of slides ago. So the top dotted line here are the cumulative returns. We've got a log scale on the left here. So they are the cumulative total returns in real terms based on Siegel's numbers. And then the blue line below that is a most recent attempt to estimate US stock returns over the 19th century. And that's been done by an academic called Ed Macquarie, who has a paper called, you see it cited down at the bottom here, Stocks for the Long Run, ? Sometimes yes, sometimes no. And that is forthcoming in the Financial Analyst Journal. And Ed Macquarie has done a phenomenal amount of work improving on the data that's used to compute these long-run stock returns. In particular, he's done a huge amount of work improving the dividend data that we had, and in also trying to correct for any survival or selection bias, and that's the particular example I'm looking at here. So unfortunately, in the Siegel series, completely ignored the existence of the Second Bank of the United States, the fact that it was a listed stock, and then more importantly, the fact that it got into trouble and subsequently delisted. At its peak, the Second Bank of the United States represented 30% of the stock market in 1836, just prior to the 1837 bank panic. And you can see from the blue line there, which is Ed Macquarie's series, how much of a dent that made in cumulative returns. And in large part explains, it's not the sole reason, but in large part would explain why we end up at the end of the 19th century on Ed Macquarie's number with a much lower cumulative return, and therefore by implication a lower annualized total return. Survivor bias is something, we have to correct for particularly when we're looking at equity indices. This chart here shows you the period from 1830 up to 1930. It's taken from Gareth Campbell, Richard Grossman, John Turner's work. It was published in European Review of Economic History. And it just shows you the frequency of delistings as a percentage of stocks that are listed. It shows you the peaks, and it also shows you the reasons why stocks are delisted. It could be because they've merged, it could be because they failed. And in some instances, it could be that they disappear and we don't know why. And in that presents the greatest problem for financial archaeologists such as ourselves, because we don't know whether a firm has been acquired for value or delisted at value. And then we are unsure, therefore, of what return we should be imposing upon that stock in the end period. This is to give you a sense of what we mean by the market in the 19th century into the early 20th century. This is for the US. And as you can see, for the first half of the 19th century, the US market consisted primarily of two, or indeed you could say for most of the 19th century, it consisted of two sectors: financials in the form of banks, insurance, and then later on railroads. Okay, and it was only when we get into the early 20th century that we have a more sectorally diversified market along the lines of what we would be more familiar with today. Another choice that we have to make is the weighting scheme that we choose to impose in the case of equity indices in particular. So this chart is taken from the original Journal of Economic History piece that was published by Richard Grossman, looking at the estimating British equity market returns from 1870 to 1913. This work has subsequently been updated by Richard and John and Gareth Campbell, of course. But it just shows you the difference it makes between choosing whether to value weight, i.e. weighting by market capitalization, or simply choosing to equally weight the stocks in the index, and therefore having to make some choice about when you rebalance, either monthly or quarterly or annually. I'm going to skip that because Elroy tells that story much better than me, and we've got plenty of slides here. Another important issue to think about when we're trying to estimate returns, and in particular in the context of the income component of returns, and this relates to real estate, but it could equally relate to bonds. We cannot just, in the case of bonds, we can't just accept the stated coupon as being the income return. We obviously need to know whether that coupon has been paid in that 6 months period, or whether no coupon has been paid or just some fraction of it. In the case, the same applies to real estate. Here is an example of a farm that was owned by King's College, Cambridge. So this comes from some work I did with Christoph Spaniers and Eva Steiner, looking at long-run real estate returns. And so it shows you for a particular farm, it would list up the rent arrears. It lists up the rents that contractual rents in the second column. It will tell you if there are any rent holidays or voids. But then this fourth column here, it tells you what was actually paid, so the realized rents. And in this case, the contractual rent was 77 plus 75 pounds, 152 pounds, and that was the rent that the tenant actually paid. So we know in this case they're the same thing, but that is not always the case. And when we're computing total returns to real estate, we want to be using the realized rents to compute the income component. This is again just reiterating the point that it's no good just looking at price only returns. The very first paper that was done before the Dimson, Marsh and Staunton work on long run equity returns was a paper by Philippe Jorin and Will Gertzman in the Journal of Finance, which was, was a very famous and well quoted paper looking at global equity returns over the 20th century. But they only used price indices, and they ignored dividends, and therefore they ignored the income component to total return. And as we'll see in the well, I'm not sure whether it's in the paper, I'm not sure it's in the slide deck, but the income component to both total return on equities, where dividends are reinvested, and also the rental yield component to the total returns on real estate account for the bulk of return. It's more important than capital appreciation, so we ignore it at our peril. How you choose to calculate the index also matters a lot. There's a famous example, and again, it's much better if you hear Elroy telling this story, which relates to the FT30 index, which was calculated as a geometric index, which is shown down at the bottom of the chart here. One of the components of that 30 share index in the early 1970s was the British aerospace company, the aero engine company called Rolls-Royce. And that company, as you can see, the copy of the Evening Standard went bust, and so the Financial Times had a problem computing that index, and in the end they had to fudge it and come out with an arithmetic version of the index. Another example illustrating the importance of index design is that for a long time, people in the UK, again before the DMS numbers were computed, used Barclays Capital as their source for estimating long-run equity returns. For this period, 1919 to 54, which was the first part of the sample period they covered, you can see they estimated a real return, quite high real return, annualized, of nearly 8.8%. If you then set about correcting various biases, the fact that the sectors they included in their index when they first computed it in the early 2000s exhibited hindsight bias with respect to sectors, hindsight bias with respect to stocks, bias from not choosing a broad stock index, but only looking at 30 constituents, incorrectly adjusting for rights issues. And then finally, the choice of start date. So the fact that they'd chosen a start date of 1919, which ignored the impact of World War I. Or if you corrected for all of these things, it led to pulling down annualized real returns. And in total, that pulled returns down from 8.8 to 3.8%, which I think you'll agree is a dramatic difference, with the 3.8 being the number for the DMS UK Equity Index 1900 to 1954. Okay, so the 5 big questions that we're looking at, I'll quickly go through are, we know a lot about 20th century equity returns, and particularly the equity risk premium. Are they, to what extent can we place faith in those when we're thinking about what long run experience has been, or to what extent might they be anomalous? Recent bond yields, at least until the last 18 months, 2 years with the inflation shock. Prior to that, bond yields had become extremely low, and some people were saying they were abnormally low. The third thing is, can we say anything more about the credit premium when we reach back into the past and move out of sample? Most of our reliable estimates for the credit premium focus on the period since the 1970s, which isn't very long at all. what can we say about long-run housing returns? And finally, commodities have become an important asset class for long-run investors in the real asset space. And people have collected data on commodity contracts and prices that go back to the 1870s. Okay, so starting with equities and looking at equities versus bonds. So we're comparing equities in the first column here with government bonds. We don't have bill returns. Of course, there are bill returns. So we got three periods here: the 19th century, the 20th century, and the first 2 decades of the 21st century. We would have bill returns for the 20th century and the 21st century, of course, but they're much less reliable going back into the 19th century. So we've chosen to compare equities with government bonds here. The two series we're looking at, so the first here in red is global financial data, which will be known to quite a lot of you. And some of you may indeed have used it. And we're contrasting that with what we call the Dimson, Marsh and Staunton Plus series, where the DMS data runs from 1900, and the 19th century data is taken firstly from Campbell, Grossman and Turner, beginning in 1830, and then the first 3 decades are drawn from Goles and Cowdis. And what you'll see is that, broadly speaking, for the UK, we get a similar story across GFD and DMS Plus. But perhaps more interestingly, we do see that the equity risk premium in the 19th century is around 1.5%, contrasting with 4.5% to 5% in the 20th century. So there is more than the hint of a suggestion there that the 19th century equity risk premium was substantially lower. If we look at the US, what's our experience? So the setup of this chart is exactly the same. We've got equities, government bonds, and then the equity premium versus bonds. Those of you who are familiar with the US government bond market in the 19th century might immediately question, well, what were the government bonds that we're using in the 19th century? Well, it's really a mixture of state and municipal bonds and corporate bonds that are of high quality. And you could argue that the bond returns here we're getting to the 19th century do include a credit premium in there. But nonetheless, taking them at the face value, again, we can see, contrasting with the high equity risk premium for the 20th century, there is a much lower premium, or indeed possibly slightly negative, for the 19th century. I think if we corrected for the credit premium that's buried in here, it would push the equity risk premium up a little bit, but I think it's still going to leave it quite a long way below the equity risk premium in the 20th century. Okay. Again, looking at the 19th century evidence on stock returns, this is for the US. We do see very much a different pattern. If you look over on the right here, in the 20th century into the 21st century, looking at 10-year moving average returns for stocks versus bonds, most of the time stocks have beaten bonds. But when you reach back into the 19th century, consistent with the lower equity risk premium that we've just been talking about, you see a very different picture. Okay. Many of you will be familiar with the work that Paul Schmelzing has done, looking at 8 centuries of global real interest rates. This ends in 2018, this data from his paper, and so we're not capturing the recent spike here. There could well be issues about how these, what these bond yields are, particularly in the early part of the sample period. But there's fairly convincing evidence here that the long run trend has been for not only nominal but also real bond yields to have contracted over time, and so we shouldn't necessarily, notwithstanding the recent inflation spike, we shouldn't necessarily conclude with that recent bond yields up to 2 years ago are abnormal. One of the things that we try to look at in the paper after looking at bond returns is a credit risk premium, and possibly the only substantial piece of long-run research that's been done on this is the paper by Schaefer, Gieske, and Longstaff and Strebelayev, which looks at corporate bond defaults over 150 years, and this shows probably one of the main charts taken from that paper, where you can see a lot of bond defaults in the late 19th into the early decades of the 20th century. Not much in the following decades, and then a bit of a spike in the early 2000s. They conclude from the paper that the average spread, corporate bond yield spread over governments, is around 80 basis points. They also conclude that the average default rate is about 90 basis points, and assume a recovery rate of 50% on defaults. The recovery rate is absolutely an assumption, and so that's one area where we really don't know as much as we should about recovery rates in the corporate bond market. The other challenge here is that corporate bonds, particularly in the 19th century, before we get into the early 20th century, don't reflect, we don't have credit ratings, and so it's very difficult to ideally what we'd like to do is to when measuring the spread is to be able to look at a AA or AAA spread versus government bonds, and we're not really able to do that. So this is measuring the credit risk premium is one of the areas where we're kind of struggling to add to the evidence out of sample, to add to the evidence that exists for the most recent, say, 40 years. I'm conscious of the time, so let me deal quickly with the last 2 points. So in terms of housing returns, there's a really extensive piece of research which you will be aware of, published by Oscar Yorda and his colleagues called The Rate of Return on Everything, which does a fantastic job of collecting returns on not only equities, bonds and bills, but also housing across 16 countries, reaching back to 1870. One of the main conclusions of that piece of research is that housing, and here this is a chart taken from their paper, it shows the real returns, total returns on bills, bonds, equities, and housing. This is the arithmetic mean return across all 16 countries in their sample, and you can see from this that suggestion is that housing returned a slight premium to equities, but with less than half the risk, and reflecting the low risk, there's a much higher geometric mean return for housing. there have been other studies of a different kind. So the Oscar Yorda's colleagues have largely used national statistical indices on prices or rent to compute these returns. Attacking things from the other end of the spectrum are papers that are done one by myself and Christoph Spanges and Eva Steiner, which looks at UK property. And there's also a paper by Pete Eichholz, Korovar, and Thies Lindenthal, and Talek, which looks at Paris and Amsterdam real estate. These are for different time periods. What I'm just showing here is real income growth, right? So I'm just showing the income growth component, which is only one component of the total return. But this is really to illustrate the different conclusions that can be drawn depending on whether you're using cross-country national data or using what we call in the paper micro data, where these data sets are built up at the property level. An attempt is being made to collect transaction prices on properties with realized rents after costs at the property level. When you do the latter, albeit this has only been done for 3 markets at the present time, and we could do with more studies, the suggestion is that the total returns to housing are quite a bit less than the estimates that have been put out there by Oscar Yorda and his co-authors. So that is an area of disagreement. Finally, and very quickly, because then I'll conclude, is we do now know quite a lot about commodity returns. Where here we're talking about a strategy that invests in commodity futures on a diversified basis. So this is not investing in spot commodities. This data set is based on data that has been collected by Geert Rubenhorst at Yale, who has collected a huge amount of data on all the commodity futures contracts that are out there. And so this is trying to take account of any survival issues. But you can see from this that this is showing the cumulative excess return of $1 invested. But down here, you'll see the implied annualized return on a diversified commodity strategy, which is over 4%, which is considerably more than the return on bonds, albeit not quite as competitive as US equities. So it looks like the historical evidence shows that there is a substantial risk premium that's available on commodity futures. I should add that this is an equally weighted strategy. Of course, there's risk, as there is. So this is just showing you the real drawdown from a commodity investing strategy in contrast with stocks. So you earn that premium because this is a risky strategy. So let me conclude. When we're trying to do this financial archaeology, for those who've done this, by and large, this is well done. But we need to be clear about what our data sources are. As academics, we're generally very good at that. We need to be clear about the choices that are being made about the various measurement issues that we've touched upon. How you choose to design the index. We need to be clear about the estimation methods used and any potential biases that might arise from the choices that are made. I haven't discussed this in detail, but problems that relate to what do you do about missing data? How do you choose to interpolate? What do you do about backcasting missing data and infilling? And any research design choices you make, obviously we want to as far as possible, be able to subject those to robustness tests. And in anything we do, we're standing on the shoulders of people who've gone previously, and we need to acknowledge the immense contributions that they have made. In terms of the big questions, I think the second bullet here, that the 20th century estimates for the equity bond risk premium may be possibly look anomalous. When we look back at the 19th century, we're only able to provide evidence on two markets, the UK and the US. The evidence on the credit premium that exists suggests that whilst it's modest, that there are issues about that out of sample estimation, and so there's some challenges that need tackling there, which may not be possible to tackle. On housing, I would suggest that there is this disagreement between the micro studies and the macro studies on what the total real return to housing is. And the suggestion is it might be lower than as previously estimated. And lastly, when looking at commodities, it looks like there is a positive and substantial risk premium there, which is now starting to be documented. So I'll stop sharing.
Great. Thanks very much, David. A very provoking and really one of those papers that is just really useful in terms of the literature review, but also contrasting and raising some of the methodological issues. So again, I'd remind our audience to put your questions into the Q&A and I will group them and ask them and hopefully get them answered. So we have a few in there already, but maybe I'll just take the chair's prerogative and ask a sort of a philosophical question. So a lot of this research is motivated by some kind of desire to anticipate the way the market's going to go in the future and sort of project back, and particularly this sort of bonds versus equities long run returns. And I wonder how you feel about those kinds of questions about, well, is this an unprecedented moment or an unprecedented period? In the way that the way these markets functioned 100 years ago was very different. The distribution of participants in these markets was very different, and this is going to affect the way that they operated and their liquidity possibly. And really, it's only maybe in the mid 20th century that you're getting the sort of more public participation in a lot of these asset markets, both in terms of house ownership, which varies across different countries, but also an exposure to equities and bonds through pension schemes and other kinds of mutual funds. Do you have a view on this?
Yes. I mean, some of the questions you raise are very pertinent, and as just very simply that chart that I showed about the sectoral composition of the US equity market in the 19th century compared to the early 20th century, they just look very, very different. And so you could say, well, the industrial landscape was different. As you pointed out, the investor landscape was different, because in the 19th century you had individual investors. In the 20th, well, not really until the mid 20th century, the market started to become more institutionalized. And so these might all be factors that might want to make you question the validity of trying to do the kinds of things that we're doing and that many other historians have done. I think I'd answer that by saying that the whole motivation of this is when you're trying to think about what returns or indeed what risk is, you really want to gather as much data as you can, I think. And there's no reason at all why, we should stop at 1900. We should go back as far as we think the data is sensible to be able to tell us something about trying to estimate either the first or the second moment. And the same is true about going across markets as well. So whether we're reaching across markets or going back in time, we want to try so that when we're looking at averages, we're averaging across all the experiences that are out there. and not just cherry picking. I think part of the justification in doing that is that who knows what impact AI is going to have on the investment landscape or the industrial landscape. And so the way the markets are, the constellation of the markets today, both in terms of industry composition and how investors behave, may well look very different 50 years from now.
Excellent. Thanks very much. Okay, so we have a couple of questions from Bert Kramer. One of them having to do with taxes and how you figure that into the returns.
So we're not accounting for investor taxes at all. In the particular case of housing versus stocks, we would account for property taxes. So property taxes would be counted along with maintenance costs as part of the cost of owning and running the property. And so we're always trying to look at, or we should be trying to look at net rental yields, net of costs, where any property taxes levied on the properties are counted as part of the cost.
I guess this complicates things for cross-country comparison as well, where the regimes are different. Would be another.
Well, it would, but to the best of my knowledge, the studies are trying to they're trying to take that into account.
Okay. So Bert kind of follows up with, in terms of the selection biases, this is very US, UK focused. And of course, that's probably where the most data and most consistent data comes from. But is there an issue or an opportunity, I guess, to spread the coverage a little bit more? And he's suggesting maybe Argentina, well, not South Korea.
Yes. So Bert is absolutely right. And from the outset, the intention is, I'm speaking for Elroy now, the work he's done with Dimson, Marsh and Staunton. The intention is to try and cover as many markets out there as possible. I'm pretty sure that in terms of GDP, global GDP, the markets that they're covering in 1900 represent 96% or more of global GDP. So in other words, the markets that are being left out, of which Argentina is one of them, to the best of my knowledge, certainly South Korea, represent very little in terms of GDP. So if we're thinking about a GDP weighted portfolio, global equity portfolio in 1900, you're not missing very much. The reason those markets are missing are usually because there are no financial archaeologists who found the data that can be used.
I'm loving this term, financial archaeologist. I think I'm going to adopt it. So William English has a more specific question about the paper that you wrote comparing the UK examples with the more global ideas on income and housing returns.
Sorry, I can't. Let me just see. Whose question was that? Say again.
William English.
Okay. Do you know why the national source provided?
I think it was where the Yorda data went up and yours didn't.
Yeah. So we do discuss this a little bit in the paper. I think it's in part a reflection of some of the selection biases that are not corrected. So one of the big issues with housing returns, unlike stocks, is that in general the quality of housing improves over time. Right, a 3-bedroom house at the same size it's built today is of better quality than a 3-bedroom house built in 1900. And when you're comparing prices over time or looking at price changes over time, you need to control for quality improvements. And the same applies to rents as well. And I do not wish to imply that what we call the macro studies, for a want of a better word, don't do this at all, but possibly the micro studies that are looking at property level data are able to do a better job of controlling for the impact of quality improvements. That's one example. And when you're looking at property level prices and rents, you are able to compute actual rental yields at a given point in time, and you're not able to do that with the aggregate, with the macro studies that are using aggregated national either price indices or rental indices. So the methodology that they use would be, for example, to use a contemporary rent price index, and then compute sort of backcast a time series of rental yields using the price index and the rent index. But the samples underlying the aggregate price and rent series may not be the same sample. You may have significant differences in the composition of housing that underlies the two samples, and so that can generate some mismeasurement. There's more detail on that in the paper, William.
Great. Okay. Stefano Bacilosi is wondering what explains the dramatic difference, I guess, between the 19th and the 20th century bond versus equity returns. Is it related to greater volatility in the 19th century, or how are you explaining that?
Well, the honest answer is we don't. I mean, we haven't. I think we do no more than offer a few conjectures. It could have something to do with particularly in terms of equity investors, the lower level of investor protection, possibly. Although ex ante you might expect to get a higher risk premium, but ex post you ended up with something in terms of equity returns that wasn't terribly exciting. It could have something to do with the relative economic performance in the 19th versus the 20th century in terms of productivity. But these are not. This is not a topic that's addressed in any detail in the paper, and it's something that, I mean, assuming we're right, even correcting for the fact that bond returns definitely include a credit premium in the 19th century. Even correcting for that, if it's true that there is a lower equity risk premium, then it bears more analysis. And it's two markets, right? Albeit two important markets.
Great, thanks. Carolyn Folan has a question sort of related to mine, I suppose, which again, looking at the institutional structures that generate this data, do you take account for ownership restrictions on various assets over time and how that changes?
No.
You can't.
Maybe you want to.
Elroy, do you want to come in?
Maybe you want to unmute Carolyn, and then she can tell me what we can do.
Well, maybe go offline for that, or wait a few minutes. Elroy, did you want to come in on that, or?
Okay, I have a connection here. Yeah, it's very difficult. We don't look at returns to owners of assets at all. We look at the returns on assets. Many of these assets have changed hands. If you were to think of the Second World War period, the assets in many cases continued but they were owned by different people, and the original owners may no longer have owned them or may have been dead. Similarly, when we look at the value of assets in China or in Russia before nationalizations, the assets didn't become worthless. They became owned by a different group of people, the nation. So that's not our focus. Our focus is to look at the value of traded assets, and that's as far as I think we can go.
Okay, I think we have one last minute to go, and it's really a question to move on to your analysis of the commodity premia from Robert Farago, who's just asking, it seems more forward-looking, he says. Do you have anything to link that to the theoretical ideas about explaining?
Do you want to take that, Elroy?
Okay, since I've sort of been unable to contribute earlier. I think that this is an important area because there are some real attractions to investing in commodity futures. But overall, the market is quite small. So this could not be a truly macro consistent strategy. If everybody shared my view, then there wouldn't be enough commodity futures to go around. For some cases, and Robert, you're interested in pension funds, it does look as though it's an area that's worth focusing on, particularly at a time when we're worried about inflationary pressures.
Great, thanks very much. And I think that draws us to a close. I think we're 1 minute over, but we started a little bit late. So I wanted to thank you both very much, David and Elroy, and I'm sure our audience thanks you also. And invite you back in 2 weeks' time on the 29th of November for Theo Alber's paper on industrialization returns and inequality. Might be a little bit of overlap there. We'll have to wait and see. So in the meantime, thank you very much. I think the speakers are willing to hang on for another 15 minutes if people had wanted to get involved in a kind of more open-ended discussion. But other than that, I think we'll stop recording at this point. And move on. Rui, let me see if I can unmute you.
Yeah, I can do that myself. Okay. Just to correct you, we're not stopping recording actually.
So, sorry. Okay.
Careful what I say.
just an advance warning. Yeah. So yeah, fantastic. I mean, this is super useful, and I really like the tone of the paper. Because it's mostly positive on how we can build up on what everyone is doing and advance our knowledge. So I have two pocket questions. The first one is on the investment horizons. Right, as the nature of the median investor changed over time, right, from retail to institutional and from different kinds of institutions, the investment horizon changed, right? And so I would imagine that volatility would endogenously affect required returns. If you're thinking of, today's pension plan or pension fund versus, a retail investor back in the heady days of the early 19th century, right? So can you say something about that, the impact of that for your interpretation of long-term returns? And the second one is the missing, I thought, obvious asset, which is land, right?
Land itself, you mean?
Yeah. You have built environment, built properties, and so on. But how about land, right? Would that matter? Because throughout the 19th century was still a very important component of the capital stock, and there was a lot of investment into it. So those are my questions. Thank you.
Yeah, okay. Well, I do know people who have done work just on land prices. I mean, I hadn't really thought. Yeah, maybe we should think about that.
There are good records of land prices, but they are quite closely associated with transportation issues. Mm-hmm. So land in the middle of nowhere is not worth very much. But to put it in a more positive way, if you're going back a long way, you're talking about the value of agricultural land, and then the question is, where's the market for the products, and what does it cost to move the products, animals, corn, whatever, to that venue? So, interesting.
So, I mean, so people have looked at agricultural land, right? And indeed that, you know, that paper we did on Britain included estimates for agricultural property, albeit it was looking at total returns. But there wasn't. I don't think the secondary market for agricultural land was that active. I'm sticking my neck out a little bit here, but certainly in England, I don't think. I mean, people. Clearly there were prices, but there wasn't a very active market, I don't think.
But it was a typical. I mean, think of trusts, right? It was the typical asset that trusts piled up their investment funds, right? So fine, it was not a liquid asset, right? But it was still important.
Are you thinking of trust? You mean trust listed on the London Stock Exchange?
No.
You're talking about family trusts.
Yeah.
Okay. Yeah. Look, I mean, it's a good suggestion. I don't know if we'll look at it in this paper.
More data, more financial archaeology, but
yeah, for somebody.
Yeah.
If you do want to ask a question, I can unmute you if you put your hand up.
So I have a question here.
Your first question, I mean, Rui, we haven't answered your first question. And all I'd say is that, again, if you think about property investors, if you think about institutions broadly defined or wealthy individuals that were investing in the assets we're looking at, property generally, I would have thought the holding periods are quite long. They might not have been that long it's not necessarily. I don't think we can necessarily infer that investment horizons were shorter the further back you go in time, right?
David, I can't help thinking that there must be evidence on rental values of farmland going back a long way. It's just not quite the sort of thing that we were focusing on.
No, I mean, there are studies. There is a study that looks at 200 years of agricultural land prices.
Mm-hmm.
I have a couple of questions. And great paper. So I didn't get to see the paper. I think it was uploaded in the last minute. But so in your bonds data, is that you have some distinction between corporate bonds and sovereigns, or is that because it would be interesting to see a corporate bond and how that relates to say equity. I mean, that's one interesting thing I think that many people would be interested looking at the long run. And then also maybe this is just a suggestion for tying the paper, your findings and the archaeology to the current debates on which are very popular now here, at least in Geneva for the last couple of weeks, is this R* debates about the decline of the real returns over time, and how that is related to developments in financial markets that are at least equity supposed to represent in some sense, in some loose sense, R* or the corporate bonds or something like that. So that could be relating it to some issues and that are interesting, I think, in terms of the longer run view of financial versus quote unquote real returns. In some ways they're measured because there's a huge industry measuring R*, which is kind of the real return on some kind of proxy or productivity or TFP or something over long run. So that could be interesting too, just a suggestion for comparison.
Well, I mean, your first question, the UK bond data is console, their console returns. For the US, it's more of a challenge. But by the way, it's not our data. Okay, so the US study that we cite is that's pulling basically municipals, corporate debt, and some federal debt, and that mix kind of changes over time. But he's doing his best to put together a sample of what he considers to be high quality bonds in the US context. But it certainly is not a long-term government bond return.
The Bank of England Millennium data has railway bonds back to 1854 as sort of their corporate bond proxy.
That's for the UK, right?
Yeah.
Yeah, no, but the UK, yeah.
The UK, we don't really need.
We don't need that. We can use consoles as the that's fine. If you're talking about trying to measure credit premium, that's a different story. But the problem you've got there is you can't identify what is a high grade bond versus a low investment grade bond. We can't do that.
Can I just give you the title that gives us one of the charts that we didn't have time to put in here? And it's Ed Quarry's working paper called The US Bond Market Before 1926. There's a subtitle that goes with it, but that's enough to Google for. And when you look at that, you find that going back 100 years, nearly all the safe, unquote, assets were federal. If you go to the 1840s, nearly all of them were municipal bonds. Corporate bonds started to appear late in the 19th century. So those are the safest you can find, but it's safest, not safe.
So I think we should say, Elroy, that we have not So Ed Macquarie is a retired marketing professor who's become a financial archaeologist, right? And he appears to have done very, very careful archival work, and he broadly speaking seems to know what he's talking about. We have not audited his returns, okay, and in particular his bond returns. So it's a survey paper, and we're taking it as is. Is that fair, Elroy?
Yeah, he'd be the first to point out that none of this work is peer reviewed. It's going through the refereeing process. In terms of peer review, our paper may be a sail ahead of any of Ed's, although he has one article which is going to appear in Financial Analyst Journal next year.
Any other comments or suggestions people wanted to make?
There's one question by Robert Farrago, or a suggestion.
Okay.
Craig Turnbull, author of a British.
Yeah, maybe we can allow Robert to speak.
You're testing me here. Okay.
Okay, I can see the comment. Yeah.
Oops.
Robert,
you read out.
Yes. Hi.
Hello.
Yeah, it was just to point out. So I used to work with Craig Turnbull. We did a paper on 200 years of asset allocation when I was at Standard Life Investments, and Craig had done most of the archival work on that, and he found that insurers had put a lot of money into private credit. There was a paper written in 1863 that encouraged pension funds insurers to invest in less liquid assets, and they ended up putting 80% of their assets into private credit, and that started to go wrong at about 1895 when agricultural prices were hit. So if you did want a contact, I'm happy to put you in touch with Craig.
I'd leap at that, wouldn't you, David?
Yeah. Yep.
Okay, well, we'll swap emails then.
Well, we have met Robert, right?
Yes,
So,
indeed. Yeah, and I'm a yeah, Elroy and I.
yeah. So thank you for that. Yeah, sure. We can. We'd be glad to talk more about that.
Can I throw in a question that really to Elroy? You've been doing your DMS studies for over 20 years. Have any of your basic thoughts on markets changed over that period? Obviously, a lot of thinking has gone into it.
When we first published our work, which was at the beginning of this century, we called the resulting book Triumph of the Optimists. And the reason we call it that was that we thought that optimists, that is people who invest in risky securities, had been lucky over the 20th century, and that one might expect something more modest looking forward to the 21st century. But we're getting on, and we're not going to see an awful lot of the 21st century to check that out. So going back gives you a rather similar sort of outcome. It looks as though this was a good century, and whether the pleasant surprises continues in the 21st century isn't clear. So I think our views, I don't want to put words into the mouths of my co-authors, but I think our view is that if you were projecting security returns into the future, they need to be more modest than we might have done it in 1999 or around that time.
Okay, I think that brings us to about 15 or 16 minutes past the hour. Maybe ending on a note of modesty is a good place to finish. So thanks so much, Ryan, David. I think that was a really great session. I think people drew a lot from it, and I'm sure it's going to be one of the most useful papers that a lot of us are able to use for both our teaching as well as the citations. So I wish you good luck with it.
Thank you.
Thanks very much.
Thank you very much for having us. Thanks.
Thank you.
Bye.
Well,
Thank you.
Bye.